Most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. In the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08-09. That's how bad this is, because bonds are selling off with stocks this time. And one of the reasons for that is a seizing up of liquidity. If people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. We're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. And so we think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation. I think this is getting to be so serious that we are reaching a cathartic moment, and I do think it started with the guilt trip. And the Fed has acknowledged that there are international ramifications to what it is doing, but it is thinking first and foremost about the U.S. This reminds me a lot of the early 80s, and what happened in the early 80s. There were two accords, the Louvre Accord and the Plaza Accord, where the Treasury ministers around the world all agreed to sell dollars to limit the deflationary impact on the rest of the world. But they are being strangled by dollar-denominated debt that they cannot service. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. Interestingly, one price indicator associated with innovation is beginning to hold up better than other prices, and that's Bitcoin. It's been interesting to see it flatline in the last month, while other indicators are reaching for new lows. Now, this is not surprising in the late stages of a bear market. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. And reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo and the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. And so Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked as it did in 1981 until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem, it was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. We've been worrying about auto credit for a while now, and now we have more reason to. Yesterday, we got the Manheim used car index. It's a value index, pricing effectively. And it dropped another 3% plus. It was 4% plus decline last month. It's declining at more than a 20% rate. Now, why is this important? Well, a lot of auto paper out there makes assumptions, or the investors make assumptions about the residual values of cars. And those residual values have been going up, maybe not as much as the used car index, but they have been firm. If we're right, the used car price index is going to collapse here. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. Under normal conditions, they didn't need that car. Nonetheless, they were quite happy to see used car prices going up, with the thought that when the coast is clear, they would sell back into the market, into the used car market. And as I mentioned, used car prices were up 54% on a year-over-year basis at one point. Now they're flat to down. And now dealers who were paying too much for used cars are sitting on losses, and they are going to have to disgorge those inventories because inventories cost money to carry, especially as interest rates are going up. So they're going to be forced to sell, and we believe that's already happening. What's another weak link in the United States? Well, corporations have a lot of debt. Why do they have a lot of debt? Well, they've been catering to short-term shareholders who want them to buy back shares and don't mind that they're leveraging up to do so, or they want them to pay dividends and don't mind that they're leveraging up, becoming more indebted. Well, this is becoming a big problem for certain sectors of the economy that are in the throes of disruption, both cyclical and secular. And I think the retail sector is one of those. We remain astonished at the inventory buildup taking place out there. And the way we're looking at this now from a deflationary point of view, and we think that's the bigger risk now out there, is the pipeline is full of deflationary indicators starting from commodities. But at the end of the pipeline, downstream at the consumer level, the latest one, pretty provocative, is Nike. And Nike is both a retailer, but it mostly sells to retail. Nike's inventories, well, first of all, its global sales were up 3% in this last quarter. Its inventories increased 44%, and that's an August quarter. There were already telltale signs that the consumer was weakening. Its North American inventories were up 68%, and the inventories in transit, mostly from Asia, were up 85%. So you know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And we think we'll see it in full force this holiday season. So you should look for and demand bargain basement pricing this holiday season. November 2nd, they're going to increase, they are saying, pretty unanimously, 75 basis points. So we took a look at the data for the last month because the Fed is saying that it's data-driven. So if it's data-driven, let's do that. And so we looked at all of the indicators for this last month, just the last month, and we found 22 firm or strong indicators suggesting employment and inflation might linger at a higher than expected rate. We found 22 weak indicators. Now, pulling out the ones that are specific to employment and inflation, since those are the two variables that the Fed is weighing more than any other. So on the weak side, again, if the Fed were data-driven, it would be paying attention to employment in the ISM index for September. Below 50% means it's contracting. The job openings, so JOLTS, they dropped 1 million in 1 month. Now still strong at 10 million. They dropped 1.1 million. That's a big drop in just 1 month. So job openings are declining. We're also seeing surveys out there, I think, in the U.S., among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year. I would also imagine that they would consider leading indicators, which in every recession and recovery, in my experience, the Fed has paid a lot of mind to. It dropped 0.3% in the last month, and that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession. So the Fed may be saying that it's data dependent, but it's looking at the data it wants to look at. It's not looking at the totality here. It's also making an assumption that we think is mistaken. It's very much a Phillips curve Fed. Now that's a very Keynes economic theory concept. And it basically says that rising output and employment causes inflation, or they're at the very least highly correlated. And that's just not true. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. So let's go to the commodity prices. Again, data-driven Fed. Are you listening? So we'll start with from their peaks. The gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%, silver down 29%, DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. Oil down 29%. And many people have been dismissing these and saying, yeah, but that's, they went to sky-high prices. They're still not down on a year-over-year basis. That's not true anymore. Having come down from $130 to $90, it is in a downtrend, mostly because of demand destruction. So just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening, but we don't think it's happening.